All right, let's get into it. We really need to talk about gold. You know, gold is usually the most boring thing in your portfolio. It's like the beige Toyota Camry of assets. Reliable, but let's be honest, kind of dull. Except lately, it's been acting, well, a little crazy.
And that's not just some funny line. It's actually the perfect description. Gold's recent performance is less steady store of value and more staying up all night making some really questionable life choices. It's just shooting straight up, and a lot of very smart people are just standing there, scratching their heads.
So that's the big mystery we're going to try and solve here. Why is the world's oldest, most traditional asset suddenly behaving like it just discovered rocket ship emojis on Reddit? What is actually going on?
Let's put some numbers on this, because it's pretty wild. For the last 40 years, gold has chugged along, giving you a respectable 6.5% average return. Fine. But recently, it's been rocketing up by almost 20%. Look, this isn't just a hot streak. It feels like the asset itself has had a complete personality change.
Now, of course, whenever gold goes on a tear like this, everybody points their finger at the same old thing, inflation. You've heard it a million times, right? Gold is your hedge against inflation. But what if this time that's not really the story?
So let's just ask the question head-on, because it's what everyone's thinking. Is the rising cost of everything the real engine pushing gold up to these insane, record-breaking levels?
The answer? In a word, no. It's the easy answer, it's the one that feels right, but when you look at the data, it just completely falls apart. The real evidence is pointing somewhere else entirely.
Okay, so here's the thing. Just think back to 2021. The Consumer Price Index, CPI, it was going through the roof. Inflation was the only thing anyone was talking about. So if gold was really just an inflation hedge, it should have gone to the moon back then. But it didn't. It just sat there. It barely budged. The timing is completely wrong for inflation to be the main villain in this story.
So, if it's not inflation, then what in the world is it? Well, the real story is a lot quieter, a lot bigger, and honestly, way more important. It's all about a slow, careful, and very deliberate breakup with the US dollar, being led by the world's central banks.
And this analogy is just perfect. Nobody is shouting from the rooftops and causing a global panic. Instead, what you have are entire countries making these really subtle moves. It's a way of signaling that they're losing faith in the dollar without actually coming out and saying it. The clues are all there, you just have to know what you're looking for.
And the data, well, it tells the whole story. 20 years ago, a whopping 70% of all central bank reserves around the world were held in US dollars. But today, that number has dropped all the way down to 58%. Now, a 12-point drop might not sound huge, but we are talking about hundreds of billions of dollars quietly slipping out of the dollar's orbit.
And you'll hear officials use this very specific, very polite word for it. They call it diversifying. But let's be real about what that actually means. Diversifying is the financial world's version of saying, hey, it's not you, it's me, but I'm definitely going to start seeing other currencies. It's just a nice way of saying they don't want to have all their eggs in the US dollar basket anymore.
And look, this isn't just some fringe theory. The evidence that they're hedging their bets is absolutely overwhelming. Because they aren't just selling dollars. They are actively and aggressively buying something else. And that something else is gold.
Just look at these numbers. For the last decade, central banks were buying on average about 450 tons of gold a year. But for the last 3 years in a row, that number has exploded to over 1,000 tons every single year. That is more than double the average. This isn't a small shift. It's a massive strategic pivot on a global scale.
And let's be super clear here. This is not a market fad. This isn't a bunch of retail investors jumping on a trend. This is institutional anxiety. We're talking about the biggest financial players in the world making a very calculated bet about what the future holds. So, what are they so worried about? They're looking at this number right here, $38 trillion. That's the US national debt. They see the United States spending over $1 trillion a year just on interest payments. That's more than the entire defense budget. And yeah, they are getting pretty nervous.
And when you're staring down that kind of uncertainty, you go looking for the ultimate financial safe space. They're buying gold because, in a world of crazy debt and digital money printed out of thin air, they need something real, something tangible. They need an emotional support rock.
Okay, but here's where it all gets really, really weird.
At the exact same time that these huge central banks are basically prepping for doomsday, another part of the market is throwing a party like it's 1999. We are living in this massive, confusing market paradox.
So on one hand, you've got the stock market hitting all-time highs, just buzzing with euphoria about artificial intelligence. It's priced for a perfect future, for utopia. Then on the other hand, you have the gold market, also at all-time highs, but it's driven by pure anxiety over debt. It's priced for an apocalypse. They can't both be right.
So what does all this mean? What are we supposed to take away from these completely contradictory signals? It means there are some deep, fundamental cracks starting to show in the very foundation of our global financial system.
And this is the bottom line, really. Healthy markets, stable markets, they don't act like this. You just don't see one group screaming everything is awesome, while another group is over in the corner quietly stalking a bunker. This kind of split personality is a giant red flag that there's some profound uncertainty under the surface.
And all of that leads us to a pretty blunt, but I think very honest conclusion. Right now, despite all the experts you see on TV making confident predictions, the simple truth is nobody really knows what the hell is going on. The smartest people in finance are all looking at the same data and coming to completely opposite conclusions.
Which leaves us all with this one last question to really chew on. Is this record-shattering gold rush just another shiny, speculative bubble that's going to pop? Or are the central banks, the people with the most to lose, the only ones in the room seeing things clearly, while the rest of the market is just high on what you might call AI hopium? The answer to that question is probably going to define the next decade of finance.